Ladies and gentlemen, Ken AG here, and I need you to focus for the next few minutes because next week, silver could make a violent move, up, down, or both in the same session. Not because of a rumor, not because someone on the internet said the vaults are empty, not because of magic or conspiracy or divine intervention, but because of three very specific, very objective mechanical gears that are about to engage simultaneously: the delivery calendar, margin requirements, and the growing gap between paper silver and physical metal. When those three gears mesh at the same time, the result is not a gentle adjustment, it is a stress test. And stress tests produce the kind of volatility that destroys people who are operating on emotion and rewards people who are operating on a framework. Today, I am going to show you the exact model that professionals use to read this kind of risk window. I am going to explain First Notice Day in plain language so that you never confuse it again. I am going to walk you through the three indicators you need to track this week if you track nothing else. I am going to lay out three scenarios with conditional probabilities, and I am going to show you the most common exaggerations that circulate during delivery months so that you can filter the noise from the signal. By the end of this video, you will understand something that 90% of retail investors never learned: that the most dangerous periods in silver are not random. They are calendared, they are mechanical, and they are readable if you know what to look for. Before we continue, the quick and necessary disclaimer. This content is for educational and informational purposes only. It does not constitute financial, investment, legal, or tax advice. I am not telling you to buy or sell anything. Always do your own research and make your own decisions based on your own situation. Now let us get to work. Let me start with the fundamental concept that drives everything I am about to explain. Every time the silver market enters a delivery month, the conversation changes. For most of the time between delivery months, people are trading price. They are looking at charts. They are watching momentum. They are debating whether the next move is up or down based on technical patterns and macro headlines. That is the normal mode of the market. Price discovery driven by opinion, sentiment, and flow. But when a delivery month arrives, something shifts. Part of the market has to stop talking about price and start dealing with logistics. Real logistics. Physical metal. Warehouse receipts. Transportation, assay verification, storage allocation. The abstract world of screens and contracts suddenly intersects with the concrete world of bars and vaults. And when price meets logistics, when the theoretical meets the physical, volatility almost always increases. Not because something is broken, because the system is being tested. The delivery process is the moment when all the paper promises get checked against physical reality. And that check creates friction, creates uncertainty, and creates opportunity for violent moves. Now, let me explain First Notice Day, because this is the term that gets thrown around constantly and is almost never explained properly. On the COMEX, which is the primary exchange for silver futures in the United States, silver is a standardized physical delivery contract. That means when you buy or sell a silver futures contract, you are entering an agreement that can result in the actual physical delivery of silver bars. Not cash settlement, not a financial adjustment. Real metal, moving from one vault account to another. The delivery process has a specific calendar with technical milestones. The most important of those milestones is First Notice Day. This is the date when the delivery notice dynamics formally begin for that contract cycle. On and after First Notice Day, the short side, the seller, can declare their intent to deliver physical metal. And the long side, the buyer who holds a position through First Notice Day, can be assigned a delivery notice. They may receive metal whether they want it or not. This is why First Notice Day matters so much, because it is the deadline by which participants who do not want to be involved in physical delivery need to exit or roll their positions. If you are a speculative long, someone who bought a contract to profit from a price move with no intention of taking delivery, you need to be out before First Notice Day. If you are not out, you might receive a delivery notice and suddenly find yourself responsible for taking possession of 5,000 ounces of silver. That is not a theoretical risk. That is a contractual obligation. So, what happens in the days approaching First Notice Day is a wave of position adjustment. Longs who do not want delivery close their positions or roll them forward to a later month. Shorts who do not want to deliver do the same. This creates a surge of activity that can move price in both directions, depending on the balance between buyers closing and sellers closing. and in a market where emotions are already elevated, where headlines are already screaming about shortages or crashes. That position adjustment can produce moves that look terrifying on a chart, but are entirely mechanical in nature. Now let me add the second gear to the machine, margin requirements. And this is the gear that most people underestimate until it hits them personally. When you hold a futures position, you are required to maintain a margin deposit with the exchange. This deposit serves as collateral against potential losses. When volatility increases, the exchange raises margin requirements. They demand more collateral per contract. This is not manipulation, this is risk management. The exchange is protecting the integrity of the clearing system by ensuring that participants can cover their positions. But the effect on the market is dramatic. When margins are raised, every participant who is operating near the edge of their capital capacity faces a choice: deposit more money or liquidate positions. Many participants, particularly smaller speculative accounts, cannot deposit more money on short notice. So they liquidate, they sell longs, they cover shorts, they exit positions involuntarily. And that involuntary liquidation creates selling pressure that has nothing to do with anyone's view on the fundamentals of silver. It is pure mechanics, capital inadequacy meeting contractual requirements. This is directly relevant right now because the CME raised silver margins again in February 2026 due to elevated volatility in gold and silver. That is the second margin increase in a short period. Each increase compounds the pressure on leveraged participants. The first hike forces the weakest hands out. The second hike reaches deeper into the pool of speculative capital and forces out accounts that survive the first round but cannot absorb another increase. That margin increase is sitting on top of the delivery month dynamics. Leveraged participants are already under capital pressure from the prior hike. New positions are more expensive to initiate, and existing positions require more capital just to maintain. And when you combine that escalating capital pressure with delivery deadline pressure, you get the conditions for moves that are fast, violent, and often counterintuitive. A sharp drop driven by margin liquidation can be followed immediately by a sharp rally as the forced selling exhausts itself and value buyers step in. You can get a 5% down day and a 4% up day in the same week. Not because the thesis changed twice, because the plumbing created forced flows that temporarily overwhelmed fundamental pricing. But when the delivery mechanism is under stress, when there are questions about whether enough metal is available to satisfy delivery requests, that gap widens. Physical premiums increase. Regional spreads between exchanges diverge. The price you see on a screen and the price you pay for a bar in your hand start telling different stories. That divergence is one of the most powerful signals in commodity markets. It tells you that the paper market and the physical market are not in agreement about the state of supply. And when they disagree, the resolution is usually volatile. So now you understand the three gears: delivery calendar creating deadline pressure, margin requirements creating capital pressure, paper physical divergence creating credibility pressure. When all three engage simultaneously, you get the conditions for the kind of week that produces both the best opportunities and the worst losses in the silver market. Now, if you can only track 3 indicators this week, track these, because these are the indicators that tell you which scenario is developing in real time. Indicator number 1, open interest in the front month contract. Open interest is the total number of outstanding contracts that have not been closed or delivered. When a delivery month approaches, open interest typically declines as participants roll or close. That is normal and healthy. It means the system is processing smoothly. But if open interest remains stubbornly high as first notice day approaches, it means a large number of participants are staying in the game. They are not rolling, they are not closing, they are standing for delivery, or they are waiting until the last moment to decide. High open interest near first notice day is not automatically bearish or bullish. It is a measure of tension. It tells you that the delivery mechanism is going to be tested more aggressively than usual. Indicator number 2, deliverable inventory. Specifically, the registered category. This is critical, and it is where most people get confused. The total amount of silver sitting in COMEX warehouses is not the same as the amount of silver available for delivery in any given cycle. Silver in the registered category has been designated by its owner as available for delivery against futures contracts. Silver in the eligible category meets the exchange's specifications, but has not been made available for delivery. The registered number is what matters for delivery stress analysis. Not total vault stock, not eligible, registered. Watch that number. If it is declining while open interest stays high, the ratio of promises to available metal is tightening. That tightening is the mechanical precondition for delivery stress. Indicator number 3, the evolution of delivery notices and position reduction during the month. Once the delivery period begins, you can track how many notices are being issued daily and how quickly the remaining open interest is declining. If notices are heavy and open interest is dropping rapidly, the system is processing. Tension is dissipating. If notices are moderate, but open interest is not declining proportionally, tension is concentrating rather than dispersing. And concentrated tension near the end of a delivery window is where the most violent moves tend to occur. The rule is simple. If indicator 1 stays high, indicator 2 stays tight, and indicator 3 does not ease, the probability of extreme swings rises materially. Now let me give you the scenario framework for next week. 3 scenarios, each with a different probability and a different set of consequences. Scenario A, volatile normalization. This is the most likely outcome. There is noise, there are sharp moves, intraday swings of 3 to 5% are entirely possible. But underneath the noise, positions are being rolled and offset in an orderly fashion. The margin increase flushes out speculative excess, which is painful for the accounts that get liquidated, but healthy for the overall market structure. Price remains highly volatile, but without structural rupture. The delivery mechanism functions. Metal changes hands. And after the storm, the market resettles at a level that reflects fundamentals rather than mechanics. This is how most delivery months resolve. Scenario B, delivery stress. In this scenario, demand for physical delivery increases meaningfully at the start of the cycle. More longs than expected stand for delivery. Physical premiums begin to widen. Regional spreads between COMEX and other exchanges, particularly Shanghai, start diverging. The market remains functional, but with what I call air pockets. Brief periods where bids disappear, where price drops several percent in minutes, then recovers almost as quickly. These air pockets are terrifying if you are over-leveraged. They are opportunities if you are prepared. This scenario requires more longs standing firm and less metal being made available than the market expects. It is less likely than scenario A, but significantly more likely than what I am about to describe. Scenario C, operational rupture. This is the scenario that gets the most views on YouTube, the most clicks, the most dramatic thumbnails. It is also the least frequent outcome. An operational rupture would require an extreme combination. A genuine rush for delivery, coinciding with severely impaired liquidity, and an inability by the exchange to absorb the flow without extraordinary measures such as forced cash settlement, position limits, or rule changes. This has happened in other commodity markets. The Mickle squeeze on the London Metal Exchange in 2022 is the most recent example. But it is the exception, not the rule. And predicting it as the base case is the kind of analysis that gets attention but loses money. Key point: saying default tomorrow gets clicks. Talking about conditional probability gets long-term results. Choose which game you want to play. Now let me address 3 common exaggerations that circulate during every delivery month, because falling for these costs people money. Exaggeration 1. Every contract turns into physical withdrawal. No, it does not. The vast majority of futures contracts are closed or rolled before delivery ever begins. Physical delivery is a small fraction of total activity. Important? Yes. Dominant? No. Treating every open contract as a delivery demand dramatically overstates the stress on the system. Exaggeration 2. If it dropped hard, the thesis is dead. In metals, a violent price drop during a high-margin environment is often a liquidity event, not a structural event. It is the mechanical consequence of capital being forcibly removed from the market. It changes the positioning landscape, but it does not change the supply deficit, the inventory trends, or the industrial demand profile. Confusing a mechanical shakeout with a fundamental shift is one of the most expensive errors in commodity investing. Exaggeration 3. If it jumped hard, that confirms collapse. Not necessarily. A sharp rally during a delivery window can be short covering, where sellers buy back contracts to close positions before they are forced to deliver metal they do not have. It can be tactical repositioning by institutional accounts. It can be a rebound from oversold conditions after a margin liquidation event. A rally confirms structural change only if it is accompanied by persistent physical tightness, widening premiums, and sustained buying that continues after the delivery window closes. Without those confirmations, a spike is just a spike. The correct way to read delivery month volatility combines microstructure analysis, calendar awareness, credit and margin dynamics, and real physical flow data. It does not rely on a single headline, a single candle, or a single data point. It is a system, and systems outperform reactions every single time. Let me close with a practical time horizon framework. Because knowing what to watch means nothing if you do not know when to watch it. For the next 72 hours, your job is not to forecast. Your job is to define risk levels. What is the price at which your thesis changes? What is the position size that allows you to withstand a 10% adverse move without panic? Build your execution grid before the volatility arrives, because once it arrives, you will not have the emotional clarity to build it in real time. For the next 7 days, watch the delivery notice evolution and physical spread behavior. These are the real-time indicators that tell you whether scenario A, B, or C is developing. React to new data, not old fear. Every day brings new information. Use it. For the next 30 days, step back and reassess the macro backdrop. Real interest rates, the dollar, industrial demand trends, Asian physical flow. If the structural thesis is still supported by the data, build your position with consistency and discipline. Not with adrenaline, not with euphoria, not with fear. Consistency. When the market screams crisis, most people choose an emotional side. They either panic and sell everything, or they get euphoric and leverage up. Professionals do neither. Professionals choose a method. They choose a process. They define their scenarios in advance. They know what data confirms or invalidates each scenario, and they execute their plan mechanically, while everyone else is reacting emotionally. The question is not will silver go up or down next week. The question is which scenario is gaining probability today, and what is my plan for each one? If you are not subscribed yet, subscribe now and turn on notifications. I will be tracking these signals daily through the delivery window and sharing updates as the data develops. If this video helped you understand the mechanics behind the volatility, hit the like button and leave a comment. I want to know, are you positioned for delivery stress or are you sitting this one out? I read the comments and I respond when I can. Thank you for watching until the end. I will see you in the next one.